Hey Scarlett, what are we gonna do?
We
Canoe?
will go in all we will go in one of these boats.
That's right. We're gonna go out here. And what's in there? Alligators and snakes.
Yeah.
Hey guys, so as I was rowing through the swamp with my family, I couldn't help but think of a specific pattern in the stock market and in markets in general. It tends to repeat itself, and that's extremely important to understand for longer term success in the market. In other words, if you want to be successful through the long term. And we came across a couple of crocodiles and or alligators, and one of them specifically had this its mouth open like this. And being the trader and investor, couldn't help but think of this specific pattern because it really looks very similar. And the pattern I'm looking at here um, is really the difference between price and volatility. And it looks something like this, and you can see it doesn't take too much imagination to think of this sort of pattern here with price and volatility sort of simulating what the open mouthed alligator looks like. So let me just get right to the point and sort of make this as clear as possible for you. What we tend to see over time, we tend to see price and volatility mean revert. What I did here is I took the S&P 500 in blue and the implied volatility index, or the SPY, in red. And you can see that each time when these things get too overextended or too far separated from each other, they tend to mean revert. So for example here, when price gets too extended to the upside and volatility is too low, ultimately they mean revert. Price comes down, volatility rises, and you see this take place over and over and over again. And at the very moment right now, and again, this is more supposed to be more of an evergreen type of vlog here, but you can see we're once again at a point here where things are starting to look quite separated from a price perspective, from a price versus implied volatility perspective. So the VIX right now, as I'm looking at, is actually trading below 12, and the S&P 500 is clearly, as you can see here, trading at highs. In fact, it's all-time highs as of right now. Now, again, it's important to understand. This is an important concept to understand. Number one, so just because price is overextended and volatility is basically overextended on the downside doesn't mean that that mean reversion has to take place immediately. You can see in the past here, if we look at this, when we had a mean reversion move, it sometimes took many months for that ultimately to start mean reverting. So just because we see these big diversions doesn't mean you have to start shorting stocks and buying volatility products or buying puts or something like that. So this is a really important point to make because a lot of people tend to automatically assume that these things are going to mean revert immediately. They usually don't mean revert immediately. In fact, implied volatility can stay low for a long time. So if we look at the VIX here in and of itself for just a moment, which is the red line, you'll see that the VIX over time has tended to stay quite low for an extended period of time. So just because the VIX is low doesn't mean it has to start rallying. So here's a chart, for example, of the VIX itself, and I use candlesticks here in this case, and you can see actually the VIX for the most part over longer periods of time, and we're just looking at a couple of years of history here, but you can see there's a lot of price history that takes place in the lower end of this big range. And just because the VIX is low doesn't mean it has a spike. Now, if the VIX stops dropping below 11, things do tend to mean revert to the upside in the not too distant future. In other words, we then tend to see a somewhat of a rise in the VIX and a fall in stock prices. But again, the key takeaway here is this hungry alligator chart pattern, which is again prices extend to the upside too far, and implied volatility gets too low. So ultimately, over multi-month periods, it is a good time to start taking the other side of this. But again, it's not an immediate term trade that has to be put on. If you're looking to protect a portfolio, then the VIX below 12 or 11 over time tends to be a pretty good spot to start buying some puts in the S&P 500 as a hedge.